The year is 2026. The crash you once thought was impossible has finally arrived, and 99% of the people who invested in silver got it completely wrong. They paid massive premiums for the wrong coins, the wrong bars, and the wrong strategy. When the collapse hit, their profit margins were already cut in half before they even began. But not you. In the next 12 minutes, I am giving you the insider list. The 5 cheapest, most overlooked forms of silver. The ones with the lowest premiums and the greatest leverage to deliver a 10 times return when the dollar finally collapses. Stay with me, because form number 1 is something most people believe is too risky to touch. Yet it is exactly what the wealthy are accumulating right now. Here is what you need to understand before we get to the list. Silver is the ultimate anti-crash asset, not gold. Silver. Gold is the banker's metal, stable, prestigious, and expensive. Silver is the survivalist's metal. It is industrial. It is essential. And right now, it is criminally undervalued. When systems collapse, silver moves faster than gold because it is affordable, divisible, and has real-world utility in manufacturing, electronics, and solar panels. But here is the trap 99% of people fall into. They buy the wrong silver. They walk into a coin shop, see shiny American eagles or Canadian maples, and pay a 30% to 40% premium over the spot price. The moment they hand over that cash, their potential 10 times return just became a 7 times return, if they are lucky. The Federal Reserve's final desperate attempt to print their way out of debt is already baked into the system. The collapse isn't a matter of if, it's when. Smart money isn't buying fancy collector coins. They are stacking weight at the lowest possible premium, positioning themselves for maximum leverage when silver finally breaks free from manipulation and hits triple digits per ounce. The secret to a 10 times return isn't just buying silver, it's buying the right silver at the right price. So, forget the pretty coins. Forget the numismatic premiums. We are stacking survival wealth. Here are the 5 cheapest forms of silver that position you for maximum profit when the system breaks. Number 5. Industrial silver scraps. This is the weird one nobody talks about. We are talking about silver anode bars, old industrial silverware, silver solder, and refinery byproducts. The unglamorous stuff that doesn't come in a nice plastic case with a mint mark. It is raw, functional, and cheap. Here is why it matters. Industrial silver trades at the absolute lowest premium because it isn't pretty and it isn't standardized. You might find anode bars from electrical refining operations, silver shot used in manufacturing, or bulk scrap from jewelry and electronics processing. The premium over spot can be as low as 5% to 10% if you know where to look. The catch? You aren't buying this at coin shops. You are buying from industrial scrap dealers, metal recyclers, or directly from businesses liquidating outdated equipment. It requires more work and verification. You need to test purity with a Sigma analyzer or an acid test kit. But for those willing to do the homework, this is the absolute cheapest way to stack weight. When silver hits $100 per ounce, nobody cares if it came from a mint or a factory. An ounce is an ounce. Industrial scrap gives you maximum weight for minimum cost, and that is pure leverage. Number 4. Generic silver rounds. This is the low-cost bullion nobody respects. These are 1-ounce silver rounds stamped by private mints, not government-issued eagles or maples. They are plain, functional, and trade at 15% to 20% over spot, instead of the 30% to 40% seen with government coins. Here is the mistake most people make. They think the government stamp matters. It doesn't. When you are trying to sell silver during a collapse, the buyer is checking weight and purity, not whether it has an eagle or a maple leaf on it. A generic buffalo round from a reputable private mint like Silvertown or Sunshine Minting has the same silver content as an American eagle, but costs $5 to $8 less per ounce. That difference compounds. If you are buying 100 ounces, choosing generic rounds over government coins saves you $500 to $800. That is an extra 25 ounces of silver in your stack for the same money. Buying tip: stick to recognized private mints with good reputations. Avoid no-name rounds or anything without clear purity markings. Secondary markets, online bullion dealers during sales, estate liquidations, and local coin shops buying back inventory are where you find the best prices on generics. You are stacking weight, not art. Generic rounds give you maximum ounces for your dollar without sacrificing liquidity. When silver goes parabolic, that extra weight is the difference between a modest profit and life-changing wealth. Number 3. Junk silver. Before you dismiss it because of the name, understand that this is the most functional form of silver for a real-world collapse. Junk silver refers to pre-1965 U.S. quarters, dimes, and half dollars. They are 90% silver. After 1965, the U.S. switched to copper-nickel-clad coins with no silver content, but everything minted before that date is real silver. It trades close to melt value, with premiums typically between 15% and 25% over spot. Here is why junk silver is genius. It is fractional. When you need to barter for food, fuel, or services in a collapse scenario, you aren't breaking out a 1-ounce round worth $100. You are using a quarter worth $3 or a dime worth $1.20. It is the most divisible, most recognizable form of silver to average people. And here is the leverage angle. Junk silver premiums spike during crises. In 2020, when people panicked about the pandemic, junk silver premiums doubled because everyone suddenly realized they needed small denominations for trade. When the real collapse hits, junk silver will be trading at 50% to 75% premiums, while you bought it at 20%. Buying tip: buy in bulk bags if you can. $50 or $100 face value bags. The more you buy at once, the lower the per coin premium. Don't worry about condition. Scratched, worn coins have the same silver content as pristine ones. Junk silver is the ultimate collapse currency. Number 2. Large silver bars, 100 ounces or 1,000 ounces. This is the high-risk, high-reward leverage play where institutional investors and serious stackers operate. 100-ounce bars and 1,000-ounce bars, also called good delivery bars, trade at the absolute lowest premiums in the physical silver market. We are talking 5% to 10% over spot on 100-ounce bars, and as low as 2% to 3% over spot on 1,000-ounce bars. Here is the math. If you are buying 1-ounce coins at a 30% premium, you are paying $39 per ounce when spot is $30. If you are buying a 100-ounce bar at a 7% premium, you are paying $32.10 per ounce. That is a 21% cost advantage. On 1,000 ounces, that difference is $21,000 in extra leverage. But here is the catch: liquidity. Large bars are harder to sell quickly. When you do sell, you are dealing with dealers or refineries, not individual buyers. You can't walk into a coin shop and expect top dollar for a 1,000-ounce bar, and you definitely can't use it for barter. This is wealth storage, not functional currency. The strategy: if you are stacking serious weight, $5,000 or more, allocate a portion to large bars for maximum leverage, but keep fractional silver and rounds for liquidity. Think of large bars as your hold until silver hits triple digits position. Lowest premium per ounce means maximum leverage. When silver goes from $62 to $620s, the person who paid $32 per ounce makes vastly more profit than the person who paid $39. Number 1. A physical-backed silver ETF. Specifically, something like the Sprott Physical Silver Trust, ticker PSLV. This is the least expensive way to gain silver exposure without paying physical dealer premiums, and it is the most liquid position you can hold. Here is why it is genius. PSLV trades at net asset value, meaning you are buying silver at essentially the spot price with zero premium. You aren't paying a dealer 15%, you aren't paying shipping, and you aren't paying for secure storage. You click a button and you own silver. Unlike paper silver ETFs that are just contracts and promises, PSLV is backed by physical silver bars stored in the Royal Canadian Mint. You can actually take delivery if you hold enough shares, though most people never do. Here is the leverage. When the silver price explodes, PSLV moves instantly. Physical silver takes time to sell. You have to call the dealer, negotiate, and ship or meet in person. PSLV sells in seconds at market price. That liquidity is critical when silver spikes and you want to lock in profits before the price corrects. But here is the warning. Liquidity works both ways. In a true systemic collapse, bank failures, exchange closures, or government intervention, ETFs can be locked down. They can halt trading or be restricted. Physical silver in your possession cannot be frozen by a broker. The smart strategy? Use PSLV for a portion of your stack, maybe 20% to 40% to capture upside with zero premium, but keep the majority in physical silver you control. When the system is functioning, PSLV is the ultimate low-cost play. When the system breaks, physical silver is the only thing that matters. Those are the 5 forms. Industrial scraps for minimum premium, generic rounds for affordable weight, junk silver for functional barter, large bars for maximum leverage, and PSLV for zero premium exposure with instant liquidity. Here is your final warning. The window is closing. The supply chain for silver is already tightening. Mints are running behind. Premiums are creeping higher, and institutional buyers are accumulating at record levels. By 2026, when the crash hits, the premiums on even these cheapest forms will explode. The only people who profit will be those who stacked early at the right price. You know the forms. Now go stack them. Drop a comment and tell me which form you're buying first. And if you haven't watched my breakdown on the 15 cities you'll regret living in during the 2026 crash, that is your next stop. Because stacking silver is only half the equation. Location is the other half. The collapse is coming. The only question is whether you'll be positioned to profit from it or be crushed by it. You know what to do now. See you in the next one. If this strategy changed how you view the wealth hidden in your vault, please subscribe and like the video. We are uncovering the financial truths that they have tried to bury. Secure your future. The next treasure of knowledge will be revealed soon.